Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon and financial mumbo jumbo. And today we're diving into something a bit different, a shareholder report from DWS DWS Investments Vidit Funds. Focusing on their DWS Equity 500, get ready for a deep dive into how our money is managed, because it's all about transparency and understanding where your investments are actually going. First up, we have the DWS Equity 500 Index VIP Fund, and this report covers the 6 months ending June 30, 2025. It's essentially a performance review, a look under the hood at what the fund has been up to. They break down the cost for a hypothetical $10,000 investment. For Class A shares, the cost was a mere $13. That's about 0.25%. Class B shares saw $13. That's about 0.64%. Remember, these are annual figures, so for half a year, that's even less. It's good to see. They clearly state these costs, so you know what you're paying for. Now for some key numbers. The fund has net assets totaling over $784 million. That's a pretty substantial amount. It holds 506 different investments, which is a good level of diversification. The portfolio turnover rate is a low 2%, which suggests a more buy and hold strategy rather than active trading. And the total net advisory fees paid out were around $462,000, which seems reasonable given the size of the fund. How is the fund actually invested? Well, nearly all of it, 99% is in common stocks, with only 1% in cash equivalents and 0% in government or agency obligations. This means the fund is all in on the stock market aiming for growth. Let's look at the sectors. Information technology is the largest slice at 33%. Financials come in second at 14%, followed by consumer discretionary and communication services, both at 10%. Healthcare and industrials are tied at 9%. The rest is spread across consumer staples, energy, utilities, real estate and materials, as heavy tech weighting is pretty common for index funds. Tracking major market indices and talent weighting is pretty common for index funds. Tracking major market indices. And who are the big players in this fund? Nvidia Corp is at the top with 7.3%. Microsoft Corp follows closely at 7%. Then we have Apple at 5.8%, Amazon at 3.9%, Alphabet, the parent company of Google, at 3.5%, and Meta Platforms, the company formerly known as Facebook, at 3%. Broadcom and Berkshire Hathaway are next at 2.4% and 1.7% respectively. Tesla also makes the list at 1.7% respectively. Tesla also makes the list at 1.7%, and JPM Morgan Chase rounds out the top 10 at 1.5%. These are all massive, well-known companies, showing the fund is tracking broad market trends very closely. Looking at the financial tables, you can see the breakdown of where the money is. The total net assets are indeed $785,719. The investment portfolio details show us precisely what's inside. Common stocks make up a huge 99.1% of the fund's investments. Within that, information technology is the largest sector at 32.8%, and within tech, semiconductors and semiconductor equipment is a big chunk at 12.6%. Nvidia Corp is the largest single holding, valued at a whopping $57 million. That's a significant portion of the fund's assets. Microsoft Corp is right behind it at over $54 million. And Apple Inc. is also a major player, valued at over $45 million. The statement of assets and liabilities gives us the fund's financial snapshot. Total assets are over $785 million and total liabilities are just over $910,000. This leaves the fund with net assets of $784 million. The statement of operations shows how the fund made and spent money. Investment income was almost $5 million. Total expenses came in just over $1 million after some expense reductions. That leaves a net investment income of about $3.9 million. This income is mainly dividends from the stocks held in the portfolio. The fund also realized over $30 million in gains from selling investments. And there was a change in unrealized appreciation of over $10 million, meaning the value of the fund's holdings went up. Overall, the fund saw a net increase in net assets from operations of over $45 million. The statements of changes in net assets show the flow of money in and out. For the first 6 months of 2025, the fund saw total distributions to shareholders of over $77 million, mostly from Class A and Class B shares. On the share transaction side, Class A shares had a net increase of almost $48 million, while Class B shares saw a net increase of about $8 million. All Class B shares saw a net increase of about $8 million. It's clear people are actively investing in and reinvesting in this fund. The financial highlights table gives us a year-by-year breakdown per share. For Class A shares, the net asset value at the end of the period was $29.35. The total return for the 6 months was about 6.07%, and for the full year 2024, it was a strong 24.63%. For Class B shares, the net asset value per share at period end was $29.42, with a slightly lower total return of 5.88% for the 6 months and 24.63% for Class B shares. The net asset value per share with a slightly lower total return of 5.0 cents with the 6 months and 24 year 2024, it was a strong 24.63%. For Class B shares, the net asset value per share at period end was $29.42 with a slightly lower total return of 5.88% for the 6 months in 2024. This difference in returns is expected due to the different fee structures for each class. The expense ratios are also important. For Class A shares, the ratio of expenses before reductions was about 0.28% for the 6 months and 0.27% for all of 2024. Class B shares had a higher ratio of 0 to C. They're actively managing costs. The notes to the financial statements are where the real details are. They define how the fund is organized, managed, and how it values its investments. For instance, they explain that investments are valued at market value and that they use a 3-level fair value hierarchy based on the inputs used. Most of their investments are level 1, meaning they have readily available quoted prices in active markets. They also talk about securities lending. The fund can lend out its securities to earn a little extra income. But as of June 30, 2025, they had no securities out on loan. Under related parties, we see the fee structure with the advisor DWS Investment Management Americas Inc., or DIMA. The management fee is tiered with the first $1 billion of net assets charged at a rate of 0.15%. For the 6 months ended June 30, 2025, they mention a contractual agreement to waive fees and reimburse expenses to keep the total annual operating expenses at 0.15% for Class A and 0.25% for Class A and 0.64% for Class B and 0.64% for Class A and 0.64% for Class B. The Board of Trustees reviews these agreements to ensure they are in the fund's best interest. They looked at performance fees and the quality of services provided. They even compared the fund's performance to market indices and a peer universe compiled by Morningstar. They noted the fund's performance for Class A shares was in the second and first quartiles for 1, 3, and 5 year periods respectively, which is generally good. The board also considered fees and expenses, comparing them to other similar funds. While the contractual management fees were a bit higher than the median, they noted that expense limitations were put in place that should keep the fund competitive. They even reduced the contractual management fee by 0.05% in October 2022. They reviewed DIMA's profitability from managing the fund and concluded the profits were not unreasonable. They even looked at publicly available data for similar investment management firms. It's good to see they're considering these factors for the benefit of the shareholders. Now for my take. This fund seems to be doing a solid job of tracking the market, especially with its heavy exposure to tech stocks. The fees, while present, are being managed and even reduced by the advisor, which is a positive sign. The fund's performance appears competitive within its peer group. However, it's important to remember that with a strong sector concentration like information technology, there's always a risk of higher volatility if that sector experiences a downturn. The fund's low turnover rate suggests a stable strategy which can be good for long-term investors. Ultimately, this report paints a picture of a well-managed index fund that's transparent about its costs and holdings. It's a good example of how to keep investors informed. What are your thoughts on the fund's heavy tech allocation or any other points discussed today? Let me know in the comments below. If you found this breakdown helpful, give this video a thumbs up and make sure to subscribe for more corporate insights. And don't forget to join our Discord community linked in the description for more discussions. Thanks for watching and we'll see you in the next video.